In this session, we're going to talk about a relatively new kind of pension. In previous sessions, we talked about defined benefit pension, defined contribution pensions, and those tend to be still the main standards of pension plans available today. However, there's a new sort of family of pension funds that we're going to talk about next. And the first one is what we call the pooled registered pension plan. So even though the pooled registered pension plan, so PRPP, is a federal act, based in other words, everybody across the land, you might say across Canada, can participate in it. It is a provincially registered type of plan. In other words, it's the provinces who actually manage the whole process. So each province then will have its own set of rules and everything. So the PRPP is registered for income tax purposes and everything else at the federal level, but as I said, each province then will design their own sort of area where, depending on their particular circumstances, the Family Law Act, all these things here will play into this as well. So it is a provincially registered type of plan. So if you're living here in Ontario, it will be according to the Ontario rules and everything else. It has a great deal of similarities to a defined contribution plan. If you remember what the defined contribution plan, we made it clear that really what it was a deposit account basically, and depending on what the savings were, how the earnings were, all those things here would determine how much money you're going to get at the other end. So there was no predetermined amount of money like a defined benefit pension plan where it said, okay, you stay with me so many years, this is what you're going to get. That's not the way this works. This basically it's really a deposit account. And then we'll see how much money you have on the other end, and then we'll decide what kind of a pension that you're going to have. The employer contribution is not mandatory. We obviously recommend that all employers, as an incentive, you might say, all employers should put in some money, $1,000 a year, whatever it is, 1% of your earnings, whatever. We always recommend that they do it, but it is not mandatory. The only thing is that you as an employer need to be able to make this available to your employees, but you as an employer do not necessarily have to contribute. But once again, we strongly recommend that you do that because that creates an incentive for the employee then to also put in their money. So, for example, for every dollar you put in, they put in $3 or something, some to that effect. So it's a good way to do it. In terms of eligibility, of course, full-time, you're covered immediately. So it's not a 2-year waiting period, vesting period. In other words, it's an immediate contribution. So you start today, you start making contributions right away. So the money there is vested to you immediately. Okay. If you're part-time, you have to be working for that company for 24 months or better. Okay. So after 24 months, basically. So first of all, 24 months, you do not participate in a pension, full registered pension plan. But after 24 months, you can do so. And remember also that in terms of the contributions, both the employer and the employee, like I said, can put in money, but none of this is actually mandatory. It could be a situation where the employer pays everything, it could be a situation where the employee pays everything, or a combination of both, basically. So it all really depends on how you set this thing up. Usually, again, we recommend both the employer and employee contribute. Then it actually works better, and there's an incentive there for everybody to contribute to the cause and everything else. Okay, the maximum limit, the amount of money that you can put into a PRPP is the same as an RSP. So, in a separate session, we will be talking about RSPs. So, whatever the rules pertain into an RSP, whatever the limits were for the RSP that particular year, it'll be the exact same limits for a pooled registered pension plan. So, we'll look at those a little later. Okay, and the benefit that you get out of it. In other words, what are you going to get out of it at the end of the day? First of all, very much depends on the income that is that's determined, basically. In other words, how much money you're actually putting in. So the funds themselves, money is locked in. In other words, you have to use that money for pension purposes. Okay, so you can't turn around and use it for anything else. Okay, that is designed basically to give you some kind of a pension. So therefore, that's why they use the word locked in that you can only use this money basically to buy some kind of a pension for yourself at the other end. Okay, so it is very much determined by the benefits are very much determined by the contributions, for example, that you make. Obviously, the more money you put in, theoretically, the more money you should be able to take out at the other end as well. Very much, of course, dependent on investments. Okay, so if the market does well, the market, your investments increase and everything else, but at the same time, you do have market risk here. In other words, if there is a situation where the market tanked and you happen to be retired at the time that the market is tanked, unfortunately, that's what you get. If you remember, that's the same situation as defined contribution. It's the same type of thing. We don't know. I can't guarantee you that at the other end of the day, you are going to have a certain amount of money. All we're saying is, make the deposit. We'll do the best we can to manage the money to give you the maximum return possible. But again, I can't guarantee that. So the investment component is very, very important. So you'll have a choice. You'll have a choice as to where your money can be invested, so you can mix and match it depending on your tolerance for risk and everything, your risk tolerance, and of course time. Obviously, the longer the time frame, the higher the possibility that you're going to get a decent return on your money. If it's a short term, you're obviously not going to get as much money. So if you're a young employee, you're in your 30s or something, you've got like 30 years, 35 years to invest. Obviously, the great possibility you're going to make kind of a lot more earnings at that time versus the person who's, let's say, he's 55 and of course he's going to retire at age 65. There isn't very much time really for that money to grow. So time is the length of time from the time that start the plan to the time you actually receive the money. It is a major factor. Again, like all registered money, always remember that all registered money is completely taxable. So regardless of what monies are in there, any amounts of money that come out, regardless of how much it is, once again, the adjusted cost base is zero, and so therefore every dollar that you take out from a full registered pension plan will be taxable at your marginal tax rate that particular year you take out that money. And we'll see you next time.